Hi, I'm Laurie Itkin. I'm a financial advisor at Coastwise Capital Group, and I wanted to record this video because I find that new investors get really freaked out when the stock market goes down, and I want to help you, if you are a new investor, feel more confident. So I've been managing other people's money for quite a while now, and every now and then I get a new client who is really new to investing. In many cases, their spouse is the one who managed all the finances during the marriage, and so they have a settlement. They're getting part of a brokerage account. They may be getting their retirement account and part of a spouse's retirement account. And anyway, their spouse isn't going to be around to manage the portfolio, so they want to work with a financial advisor. Well, what I find is that I may be with a new client, and a few days or a few weeks or a few months after we start working together, I've invested their money, the stock market goes down 1 or 2 or 3%, and they look at their portfolio, because everyone has smartphone access now to everything, and they're like, Laurie, I lost money. You made me lose money. No, you haven't really lost money. So let me explain. This is going to be some basic financial literacy 101. I thought about what's like the most boring company I can use in this video, and I settled on Pepsi. Pepsi, been around forever. You may not drink it, I don't drink it, but whatever, Pepsi. And Pepsi is one of the few companies in the US that is called a dividend aristocrat. Other dividend aristocrats include Walmart, Chevron. Hey, you may not like these companies, but they are also dividend aristocrats. Coca-Cola is a dividend aristocrat. What that means is these are companies that consistently raise their quarterly dividends. They raise the paycheck they send to shareholders, and I like that. I like owning a stock and getting increased pay. No different than if I owned property and I rented it out for income. Hey, every now and then I'm going to increase that rent, right? Get a bigger rent check. Same thing here. They're giving me a bigger shareholder dividend check. So many stocks pay dividends 4 times a year, quarterly dividends. And I'll get to that in a minute, but I wanted to talk to you about Pepsi and the share price. Here is a 5-year chart of Pepsi, the share price. Now you can see that over 5 years, the price has gone up, but it's not been a smooth ride. So think about the clients that I got in early 2020, and we had the COVID stock market crash, and they're looking at their account statements or their portfolio on their smartphone, and they're saying, holy crap, I've just lost 20% of my account or 30% of my account or what have you. But look how quickly it rebounded. And so all along the way, you got this boring company. This isn't some AI thing. This isn't some electric vehicle thing. This is freaking Pepsi, okay? And it still jumps around like that because that's what stocks do. So you should expect, if you are an owner of Pepsi, that every few weeks, up, down, you're going to be up, you're going to be down, you're going to be up, down. And this could be like any company, right? So I'm not telling you to run out and buy Pepsi. This isn't a recommendation to buy Pepsi, but I would say if you had a portfolio and you bought some Pepsi and you bought 10 other companies that paid dividends, hey, that wouldn't be so bad. So what I want to say is that I have clients that will say, when they're new to me or just new to financial advisors in general, the minute they have a day where the stocks went down, the index went down 1%, 2%, 3%, then you hear the NASDAQ went down 2.5%, the Dow Jones Industrial Average went down 1%. I get a call, I get a text, I get an email. Gee, Laurie, should we sell this? Oh God, Laurie, I lost money. Yet you don't always hear from them when the stock market goes up 1, 2, or 3%, but that's just the way it is. So I want you to understand this is normal, even for a boring company like Pepsi. Okay, now let's get to dividends. So I mentioned that Pepsi is a dividend aristocrat. What that means is that we look at the history of the dividend payout, and you can see every 3 months it pays a dividend, and it's expected to pay one in September. Now, right now, every quarter, they're paying $1.30 per share. They were paying $1.26, and prior to that, it was like $1 a share. And we go back here, it was 80 cents a share, 70 cents a share. So you see, they've been raising their dividend. And if I own $100 worth of Pepsi, I should expect, although it might be slightly lower or higher, I should expect that after 12 months, I will have earned $3.14 on my $100 because the dividend yield is 3.14%. Okay? But it's been increasing, so the dividend yield will change based on the payout and the stock price. But the whole point is that if I'm with a stock that has consistently paid dividends, and even in 2008 when we had the financial crisis, if they didn't cut or suspend their dividend, that's telling me that they're probably more reliable than other companies that may cut their dividends. So why should I be freaked out if the price is going up and down like that other chart I showed you, if I know I'm getting quarterly income? Okay, but let's say that, let's go back here, and let's say, okay, Laurie, that's fine, but I really don't like having to see this going up and down all the time. You know, I just invested $100,000 in this account with you last week, and now it's worth $99,000 or $97,000. Okay, so you have options. If you are 42 years old and you have an IRA of an individual retirement account or a 401k, you shouldn't even think about pulling any money out until you're at least 59 and a half, because not only do you pay federal and state income taxes on that money if it's a traditional or rollover IRA or 401k, but you will pay a 10% early withdrawal penalty, and if you live in California, another 2 to 2.5%. So you may be actually only getting 50 cents on your dollar when you pull that out if you don't wait a long time until retirement age. So you're not going to touch this money for at least 15 years, right? So why do we care about the daily, weekly, monthly gyrations of this roller coaster when we've seen, for example, this stock over 5 years did go up? Now, I'm not saying all stocks go up over 5 years. You don't want to just choose any stock. You want diversification. You want to have your eggs in many. You don't want to have all your eggs in one basket. You want to have tons of eggs spread out in many baskets. But my alternative is I could say, well, Laurie, I don't like these gyrations. I hate thinking I've lost money, even though you haven't really lost the money until you sell it. And you're not going to sell it if you don't need the money, even though you think you want to sell it because you can't stand it. You could go into a CD at the bank, okay? Or we have alternatives like treasury bonds or very short-term bonds you can invest in. But let's just say, on average, when you have normal interest rates, right now they're high, that you could earn 3% a year, but less volatility. Not a total flat line, but less chance that you're going to lose 30% in a stock market crash. Well, let's say you can get 3% a year. There is a rule of thumb called the Rule of 72 that says that if you were to get an annual return of 7.2% every year, your money would double in 10 years. That's about, stocks, a diversified stock portfolio, the S&P 500 might return about 7.2% over a 10-year period per year. That's in the range. And so if you invested $100,000 when you were 40, you could expect, give or take, to have $200,000 by the time you're 50. But you tell me, oh, Laurie, I can't stand these ups and downs. Well, then you could invest in a fixed income alternative. Maybe you can secure a bond that pays 3%. Or when we had really low interest rates, let's say in your savings account in your bank, you were getting 1%, if that. But let's just say you said, you know what, I barely want to make any interest. I don't want I don't want to risk any principal loss on my money. So I'm going to invest it something safe that I get 1% a year. Remember I told you if you invested at 7.2% a year, your money would double in 10 years? Guess how many years it would take you to double your money if you invested it in something earning 1% a year? 72 years. My 42-year-old woman example would be dead before her money doubled. So here's what I want you to think about. If there's money that you're investing, like in a retirement account, that you're not going to need for at least 10 years, you've got to be in stocks. Probably mostly stocks, maybe all stocks. Because over time, stocks will return more than bonds and CDs and high-yield savings accounts. However, I don't want you to leave without hearing this. For money that you're going to need to withdraw in the next year, 2 years, or even 3 years, I would not invest it in stocks. No way. Because when we look at the worst market crash of our lifetime, which was the 2008 market crash, it took over 3 years for stocks to recover. And if you had to pull money out during that 3.5 year period, you would have had to probably sell at a loss. And yes, you would have lost money. So let's be realistic and practical and be a planner. If you are going to need to make a down payment on a house, if you're going to need to buy a new car, if you're going to need to send a kid to college or private school or whatever you're doing with this money, get a surgical procedure, whatever, in the next 3 years, keep it in treasury bills. Keep it in a CD. Keep it in a high-yield savings account. Do not invest it in stocks. Otherwise, you're risking loss of principal. So, the important lesson as I get here to the end of this video is that for money you're not going to need for 10 years or more, don't even complain that it's going up and down, okay? If you're in a well-diversified stock portfolio with a bunch of companies representing a bunch of industries, a bunch of sizes, you should be fine and it will serve you well. But if you are looking to make a quick buck over the next 3 years, don't do it. If you need to pull that money out, don't do it. Be safe, be conservative. All right, I hope that tip was helpful for you. I'm Laurie Yitkin. I'm a financial advisor who believes in financial literacy. It's so important. And you can reach out to me at my website, The Options Lady. That's theoptionslady.com. Laurie Yitkin, thank you.